To some investors, it's the king of ratios. To me, it's more like the prince. Okay? The price to sales ratio is one of the most useful ways to decide whether a share is cheap or expensive, and it's been shown to be a good predictor of future share price performance. All right, so let's take a look at what the price to sales ratio is, how you calculate it, why its fans love it, and some of the downsides as well. All right, okay, so the price to sales ratio, how would you go about doing it? Well, one of its great benefits is it's a nice, simple, clean ratio to number crunch. All you do for the price to sales ratio is take the market capitalization, MCAP, of a firm and divide by 12-month sales, usually the last 12-month sales. Okay, now you can do it on a total basis. So market capitalization is number of shares times share price, the equity value of the firm over sales, or you can calculate it per share. So you could do the current share price divided by sales per share. You should get the same answer. So for example, if you knew that a firm's market capitalization was, let's say, 80 million in sterling, and you know the sales figure is 100 million, then the price to sales ratio is 0.8. Okay, mechanically that's how it's done. So what? Well, studies have shown, the famous book What Works on Wall Street in the mid-90s, for example, that where the price to sales ratio is below 1, subsequent share price performance is normally strong. Okay, well above 1, or watch out. All right, you're looking at an expensive stock. So, very simple and very simple to interpret. All right, so that's why for many people it is one of the strongest ratios out there. But what other advantages does it have? How else can you use it? Well, first off, notice it uses the sales figure rather than something like earnings. So the price to earnings ratio would use an earnings figure, and earnings are easier to kind of manipulate and play around with if you're directors of the company. So fans say this is a stronger ratio because it uses a sales figure. It's harder to play around with the sales figure. Now you can debate whether you use the sales figure from the formal accounts last published, or whether you try and sort of use an updated rolling 12-month figure that incorporates the recent most up-to-date quarterly or half-yearly figures, but nonetheless sales is a little bit trickier to manipulate. So fans say not only is it simple and straightforward to calculate and interpret, but it's based on a number which is both vitally important. Without sales, a business really is nothing, and also is perhaps less subject to accounting whims in the way that, say, an earnings figure could be. And it's useful for firms that are growing very quickly and may have little or no earnings, or their earnings are very volatile. Okay, if you have no earnings figure, you can't do a PE ratio because there's no E in effect. Or if earnings are swinging around all over the place, you'll get very sort of meaningless or difficult to interpret results. So what a lot of people did, and the reason the price to sales ratio got itself a kind of dodgy reputation a while back, was they said, great, we'll actually use this as a substitute for the PE ratio. So what we'll do when the dot-com boom came along, and they said, well, here are companies with no earnings, what we'll do is we'll substitute this for the PE ratio. So you started to get some ridiculous assumptions being made, like, well, if a firm has a PS ratio of 10, it's cheaper than a firm with a price to sales ratio of 20 or 50. Well, in one sense that's true, but don't forget the studies that have done homework on the price to sales ratio say a bargain is where the price to sales ratio is below 1, not below 10 or below 20. So in the dot-com boom, it got kind of misapplied, if you like. And if you've heard people say, well, watch out for the price to sales ratio, it's probably because of that. All right, but that's no reason to dismiss it from today's stock searches. Now, is it perfect? No, it suffers some drawbacks. Okay, so I'm not going to suggest from this video that you go out and just replace what you were doing before with one number, the price to sales ratio. What are the drawbacks? Well, first of all, sales isn't profits. At the end of the day, okay, as Lord Sugar once said on The Apprentice, you can take £10 notes and sell them for £9 all you like, but that's not a business. It'll have turnover, okay, but you're making no money. So you've got to look at earnings at some point. You can't simply assume that because a firm's making sales, okay, it will make you money, all right? So there's criticism number one. And criticism number two would be the debt trap. Okay, what I mean by the debt trap is this. It's perfectly possible for a firm to basically be generating decent sales, but for the market to be worried about it, maybe because it carries a lot of debt. All right? And the problem is this ratio doesn't explicitly reveal that in one sense. So you might think, brilliant, this stock's got a low price to sales ratio, but the reason is the market is worried, frankly, about debt repayments, interest repayments, and the fact it might even go bust. So you pile in on a price to sales ratio of 0.5, all right, and a few months later, in a worst case scenario, the firm's gone bust. All right, no one warned you. Well, that's the so-called debt trap. And one of the ways that you can correct that, if you like, is to substitute the market capitalization on the top, which only really considers the equity value of the firm, with something called the enterprise value. Now, I actually cover what is enterprise value in a video, not surprisingly entitled, What is Enterprise Value? All right, so do take a look at that video if you want to know more, but just be aware that that debt trap can exist. And here's another problem, okay? I personally wouldn't use the price to sales ratio in certain sectors. I wouldn't use it on financial firms, and the reason is that the way they report revenue is a little bit different to other sectors. Okay, it doesn't really work so well. I also wouldn't use this ratio in asset-intensive sectors, so I wouldn't apply it directly to investment trusts, for example, or property investment companies. Right there, other ratios, perhaps like the price-to-book ratio, which again I cover in another video, might be more useful to an investor. Okay, so the message coming through from this short video on the price-to-sales ratio is this is a useful, simple, easy to calculate, easy to interpret ratio potentially. Okay, but like all ratios used in isolation, it can be dangerous. Okay, so my advice would be have the price to sales ratio in your armory as long as you apply it to the right sector, and I mentioned two where I wouldn't apply it, but do use it alongside other valuation ratios. And if you want to see what some of those other valuation ratios might be, do take a look at my video 6 ratios that every investor should know. Okay, and there I suggest a sort of little mini portfolio of ratios that you can apply to determine whether or not a stock is genuinely cheap or expensive.